Stop what you're doing. If you own healthcare stocks, or frankly, any dividend-paying value plays, you need to see this 5-model valuation breakdown. Last week, I ran National HealthCare Corp, NHC, through 5 financial models and 2 legendary checklists, and what I found completely shocked me. We're looking at a company whose intrinsic value might be nearly 300% higher than its current trading price. It's the exact kind of setup that would make Warren Buffett salivate over the deep cash flows, but might make Peter Lynch run for the hills due to some fierce industry headwinds. Welcome to another explainer. Today, we're diving into NHC's massive valuation paradox. Now, are you terrified of buying into a value trap right before market correction? It is a massive pain point for retail investors right now. Well, by the end of this explainer, you'll know exactly if NHSC is a brilliant Buffett buy or a classic Lynch trap, and you'll have a clear, actionable framework to steal for your own analysis. Let's look at the sheer scale of the operation first. NHSC just reported a record-breaking $1.517 billion in net operating revenues for 2025. Thanks to a rising skilled nursing census and aggressive per diem rate negotiations, their top line is absolutely exploding. But juxtapose that billion-dollar momentum against this completely jarring reality. The average analyst price target for NHC is hovering right around $88. That is a staggering 54% downside from its current price of roughly $192. So we have a massive contradiction on our hands. How does a company grow its revenue to $1.5 billion, significantly expand its footprint, and yet Wall Street quietly predicts it's going to lose more than half its value? So why is Wall Street so hopelessly divided? What hidden liabilities are the bearish analysts seeing that the trailing earnings aren't showing us? Let's dive into the data and figure this out. To unpack this, here's our game plan. First, we'll break down the financials by the numbers. Second, we'll evaluate their $560 million real estate flex. Third, we'll weigh the macro industry headwinds against the tailwinds. And finally, we'll contrast the great valuation divide. All right, Section 1, Financials by the numbers. A record-breaking year. NHC is just firing on all cylinders right now. They're reporting a 16.1% jump in net operating revenue, bringing net income up to $120 million. Now, put that into perspective. That translates to a 17.7% earnings growth rate, which absolutely obliterates their historical 5-year average of just 2%. Plus, they recently hiked their quarterly dividend to 67 cents. So they are actively rewarding shareholders, all while maintaining zero debt on their Q1 2026 balance sheet. Zero debt, that's a massive green flag. And when you look closely at executive alignment, it gets even better. CEO Steve Flatt's $2.68 million total compensation is incredibly carefully structured. They clearly want to avoid excessive risk-taking, so his pay relies heavily on performance pools tied directly to pre-tax earnings and clinical quality metrics, like 5-star ratings and patient satisfaction. So leadership is quite literally financially invested in the safe, profitable operation of these facilities. Moving on to Section 2, the $560 million real estate flex from tenant to owner. For years, NHC operated primarily as a tenant. They were leasing 35 properties across 7 states from national health investors. But now, they're pulling off a massive pivot. They are converting those long-term lease obligations into owned real estate by straight-up buying 32 skilled nursing and 3 independent living facilities for $516 million. This is a total game changer. So how is this going down? Well, utilizing a brand new credit facility, NHC put down a $5 million initial deposit. Following a thorough due diligence period ending in late May of 2026, they expect this highly accretive deal to clear antitrust hurdles and officially close by the 3rd quarter. This move fundamentally shifts their capital structure from bleeding cash on rent to building massive long-term equity. Which brings us to Section 3, Industry Headwinds and Tailwinds, the macro funnel. Look, a company is only as strong as the environment it operates in, right? The good news here is that the post-pandemic recovery has been remarkably steady. National skilled nursing occupancy climbed back from a historic low of 67% in 2021 up to 77% in 2024, and it's projected to hit 80% by 2026. The baseline demand for patient care is undeniably recovering across the board. The funnel is definitely filling up. But here is where the operational friction gets incredibly severe. Sure, higher hospital discharges are driving up demand, and yes, NHSC boasts fantastic quality metrics with over 62% of their facilities rated 4 or 5 stars. But the headwinds? They are fierce. We're talking about massive staffing shortages, specifically a 21% national decline in registered nurse hours since 2015. Pair that with a major industry shift toward lower-paying Medicare Advantage plans, and you've got a recipe for severely squeezed capacity. To put it bluntly, you simply cannot fill beds if you don't have the nurses to staff them. Let's wrap it all together in Section 4, the Great Valuation Divide, bull versus bear. This collision between strong corporate financials and a highly stressed macro environment leads us right to this great valuation divide. The market simply cannot agree. Discounted cash flow models, which, remember, look strictly at the raw cash the company is generating, suggest its intrinsic fair value is $481.91. That is nearly triple its current trading price. But on the flip side, bearish analysts are forecasting a massive 54% drop down to roughly $88. Guys, it is incredibly rare to see a chasm this wide in financial modeling. The psychology driving these two camps is fascinating. The bulls are totally locked in on NHC's trailing PE ratio of 21 and its soaring earnings growth. They see a fundamentally sound business that's brilliantly buying its own real estate. The bears, well, they are entirely fixated on systemic risks. They see heavy reliance on government Medicare and Medicaid rates and persistent labor bottlenecks that could cap future occupancy regardless of how much real estate NHC actually owns. Amidst all this noise, NHC's leadership is holding their ground. CEO Steve Flatt explicitly stated that shifting from tenant to owner will provide maximum flexibility to execute our long-term vision. They are heavily banking on the idea that this real estate acquisition will solidify their cash flow, totally insulate them from future rent hikes, and ultimately prove those bearish Wall Street forecasts dead wrong. So what is the ultimate takeaway here? We're looking at a truly fascinating financial mystery. Will NHSC's bold real estate expansion empower it to conquer the national staffing shortages and unlock that massive discounted cash flow value? Or is Wall Street actually right to be hyper-cautious about a heavily regulated industry facing severe labor crunches? It is a textbook battle of strong microeconomics versus incredibly tough macroeconomics. So what do you think will break first, the bearish analyst targets or the company's incredible growth streak? Let me know.